I'm trying to see what book is on Russell's
Yeah,
bookshelf.
yeah, I'm a bit worried about my bookshelf. What's up there? Yeah. So, what are you seeing up there, Theodora?
Hello, everybody, and welcome to another monthly Finimize Analyst Roundup, this time for the month of May. Thank you for tuning in, and as usual, we're going to follow our usual format. First of all, I'll give you a quick update on performance, so how the Finimize Analyst ideas have been performing and our average performance. Second of all, we will recap last month's research. And then third of all, which is probably maybe the most exciting for all of you, is we will answer the audience Q&A. So thank you to everyone who submitted questions beforehand via email. We're going to try to answer as much of those as possible. And for those of you who didn't and you have a question to ask, feel free to email us and we'll answer them at the next monthly webinar. So without further ado, I'll just kick off quickly with performance. So the latest performance stats as of, I believe, the 2nd of May, so just a few days ago, on the Saturday. Since launching Finimize research in October 2024, our investment ideas have delivered an average annualized return of 38%, beaten their benchmarks, usually the S&P 500, by around 17 percentage points, and have made money on 83% of the calls. Okay, so that's on an annualized basis. If you look at the average performance, so average absolute performance of every single idea we have out there, that's like 40 ideas, combination of open, closed ones, and so on. The average absolute performance sits currently at 29%. And I really want to emphasize that this is an actual average that includes the good, the bad, and the ugly. So every single idea, whether it's made money or whether it's lost money. Because remember, the name of the game in investing is not to be right every single time, but to be right more often than you're not. And when you're right, to make a lot of money. And when you're wrong, to limit the damage and hopefully don't lose a lot of money. Now, with that out of the way, I will pass on to Theodora, who will discuss very quickly, give a very quick overview of her latest research piece.
Great, thank you, Reda. So, yeah, my latest research idea is that the global power grid is becoming one of the biggest bottlenecks in the global economy, and it's likely to be one of the most interesting investment themes over the next decade. So, not a very short one, a pretty long one. And I think, as you know, I started with the AI data center story. Everyone talks about chips, servers, and cloud companies, but then the one thing I kept coming back to was power. A data center does not just need GPUs, it needs a constant, reliable supply of electricity. And I think once you follow that thread, the story becomes much bigger than AI. You've also got EVs, heat pumps, reshoring, renewables, and industrial electrification. And all of these together are all putting new pressure on an electricity grid that was mostly built for a very different world. So, yeah, that's the core idea. The economy is becoming more electric, but the grid is old, it's underbuilt, and it's not ready for demand that is coming its way. The other thing to note as well is that in the US, many transmission lines are already decades old. And in Europe, energy security has become a national priority since Russia's invasion of Ukraine. Both China and India, as well, and Asia, they're both spending heavily to connect renewable power to cities and industry. And so add it all up, and the global grid investment pipeline could reach about $5.8 trillion in the next decade. And what we've seen recently has only strengthened the case. So the White House has now classified grid infrastructure and related supply chains, including transformers, transmission lines, substations, high voltage circuit breakers, etc., as very essential to national defense under Section 303 of the Defense Production Act. And this is super important because it opens the door to federal purchases, commitments, what have you, like financing support and other tools to expand the US domestic grid capacity faster. And so the way I'm thinking about investing in the opportunity is in phases. So I think in the first phase, the world needs to replace critical bottlenecks like transformers. That's the lowest hanging fruit. And then in the second phase, it needs to start building long distance transmission lines and HVDC systems to connect offshore wind and remote renewables to the centers of demand, the places that actually need electricity. And then after that, once that transmission line is connected, you need to think about the local grid. So smart meters, software, EV charging, and grid management. And then, finally, the last angle of the portfolio in which I've included is the grid bypass angle. And the rationale behind that is, some data centers actually need to generate power on site. They need to bypass the grid because they can't wait years for the grid connection. So I think, long story short, it's not just a utility story, it's a full value chain story. And the companies in the portfolio are spread across the US and Europe too. I've got GE Vernova, Hubble, MYR Group, and Bloom Energy in the US. And then in Europe, I've got Prysmian, NKT, Siemens Energy, Schneider Electric, and ABB in Europe. Some of the names in the last month have done very well already. So I'm talking about GE Vernova and Bloom Energy. But the beautiful thing about the portfolio is that you can either pick individual stocks depending on the different phases of my investment strategy that you like, where you have the greatest conviction, or you can simply spread exposure across the basket to reduce your single stock risk. But you can definitely read more about it in the drop included here. That's it for me, a very short roundup. I'm going to hand over to Russell, who is going to talk about a very exciting company in a completely different region.
Hey, thanks, Theodora. Yeah, those GE Vernova and Bloom Energy. Wow, yeah, what incredible investment returns they've been so far, yeah. But yeah, if AI spending continues, they could still do sort of well from here. So yeah, as Theodora, as you said, I've kind of moved across to Japan, which has been seeing a big increase in activism over the last few years. And I've added a company called Daikin to the portfolio. It's the world's biggest air conditioner maker by sales. It was founded over 100 years ago. I've got a bit of history with this one. I used to live in Tokyo and I spent more than 20 years working in trading and sales in the Japanese market. Back then, Daikin was one of those dependable, high quality names that seemed to pop up in portfolios everywhere. But that was a while ago and times change. In April, activist hedge fund Elliott Management announced $1 billion stake in the firm, equal to about 3% of outstanding shares. Elliott praised the business and its long-term growth record. After all, sales are just reaching record highs, but made the bigger point that the company looks serious undervalued. See, its profit margins have been in steady decline over the last few years, and it really needs to fix that to catch up to its peer group in terms of profitability and also the stock valuation. You see, it's sort of trading cheap relative to its peers. Elliott spelled out clearly in a presentation document what it needs to do to fix some of these issues. It should sell some of the underperforming and non-core businesses as part of its upcoming management plan, which is due later this month, and also announce a massive share buyback of about $6 billion, which it says it can easily afford. The reality is the company sits with a net cash on the balance sheet right now. So all eyes are on the midterm plan sort of later this month. And the point is, even if it doesn't do everything that Elliott says, at least initially, Elliott in the background and the activist approach that it takes will mean that it will keep the pressure on the management. So that ongoing pressure is the reason why I think it deserves a place in the Finimize portfolio. So I think now we're moving from Japanese air conditioners to something a little bit more, forget Japan, yeah, we're going somewhere else, yeah. Where are we heading to?
So let me think, where on Earth are we heading? Actually, it's nowhere near on Earth, Russell. We're heading to orbit because I want to talk about SpaceX for a little bit. Now, the caveat is this is research that is a work in progress. It's not something I published in April, but look out for it as early as next week. And I am doing a piece on SpaceX because I'm sure we've all heard the news. SpaceX is heading for what could be the biggest IPO in history, a roughly $75 billion offering at a valuation north of, are you ready for it, Russell? $1.75 trillion, potentially as soon as June. Now, these are mind-boggling numbers, right? It's 2 trillion and beyond if you want to think about it. Look, SpaceX was valued at $800 billion in a share sale in December. And then Elon Musk marked it up to $1 trillion in February when he merged it with xAI, which he valued at $250 billion. So the combined entity was worth $1.25 trillion. So I'm talking about SpaceX and xAI, which owns the Grok chatbot, and X, which was previously called Twitter. Now he is targeting $1.75 trillion in an IPO, and there are rumors that it could head over $2 trillion. So, if you think about it, something that was worth 800 billion in just a few months ago is now targeting an IPO potentially north of 2 trillion. Okay. And now the valuation is, literally in the stars. Okay. So SpaceX made almost $19 billion in revenue in 2025, up from 14 billion the year before. So very impressive growth for sure. No denying that. Starlink, which is SpaceX satellite internet service, accounted for roughly 2/3 of that revenue, with rocket launches accounting for the other third. Consolidated EBITDA was roughly 8 billion. So if I look at the valuation numbers at $1.75 trillion valuation, SpaceX would trade at a trailing price to sales ratio of over 90 times. And assuming net debt is zero, I have to assume because we still don't have public financials yet. Assuming net debt is zero, then trailing EV to EBITDA of over 200 times. For reference, Palantir, which is currently the most expensive stock in the S&P 500, trades at 70 times trailing price to sales. So we're talking about SpaceX at over 90 times. So it would immediately make it the top 10 biggest stocks in the S&P 500 by market value, but it'll definitely make it the number one most expensive stock in the S&P 500 by trading price to sales. Now, of course, people are not valuing SpaceX on what it made last year in revenue and EBITDA, right? But they're valuing it on what the company could become in the future. And there are a few key things over here. Some things to highlight. If its giant Starship rocket, currently under development, becomes fully operational, it could reduce the cost of launching payloads into space by several orders of magnitude. We're talking about the most powerful rocket ever being developed that is fully reusable. I'm not talking about the first stage, like the Falcon 9 rocket. I'm talking about the whole thing, okay? So that could be a step change in the economics of sending things or people to space. Second of all, Starlink currently has around 10 million subscribers. That's a very tiny fraction of the global internet market, right? If you think about it, there are 7 billion people, right, on Earth, and how many people have multiple connections on their phone, at home, etc., etc. And we're talking about Starlink that only has 10 million subscribers, okay? Now, if it can capture a more meaningful share, it will represent a huge growth opportunity in a highly profitable segment with EBITDA margins above 50% for Starlink. Another big growth opportunity for Starlink is direct-to-cell mobile service, okay? So this is having your mobile phone connect directly to the satellites for data. And actually, SpaceX's 2025 acquisition of EchoStar's wireless spectrum shifted Starlink from a roaming layer add-on via partner carriers like T-Mobile into a spectrum-owning platform that can compete directly with carriers. So that could be a very big growth opportunity. Now, beyond that, which do sound reasonable and are reasonable, we have genuine, literal moonshots. So we're talking about things like AI data centers in orbit, something I've written about actually quite recently, establishing a base on the moon, manufacturing and launching satellites from the moon. So instead of launching satellites from Earth and using a lot of chemical rocket fuel, hey, why don't we just push them using the low gravity service off the moon and straight into orbit, settling Mars. So a lot of wild ideas out there, which is what you would expect from someone like Elon Musk. None of these are economically viable today, and many rely on unproven technologies. But the pattern with SpaceX is that ideas that sounded ridiculous when first announced, like reusable orbital rockets or a million customer satellite broadband network, have a way of eventually working. So will they work? All right, well, you got to look out for my research next week, where I'll basically break down SpaceX's core businesses, how the IPO might work, what to look out for. the bull and bear investment cases, and how to even begin putting a price tag on a company this big and unique. So look out for that. But with that out of the way, I'm sure that's probably the number one pressing question, right? What is SpaceX worth? But we're going to move on to audience questions first. And yeah, perhaps we can kick off with a question from Kian for Theodora.
Yeah, so great question from Kian, and I think it's wise that you are questioning the kind of information that you're getting. So I think one thing about online finance influencers, I'm going to call them Finfluencers for short. And so I think that Finfluencers, one thing that they have done is that they have made investing much more emotional, especially when markets are falling. So, the thing is, you open your phone, you see a scary chart, a crash warning, or someone saying, well, that happened before in 2008. And then suddenly, a normal market wobble that you're seeing can feel like the start of something much bigger. And I get why it works, right? In uncertain moments, we all want clarity. There is just a risk. There is loss aversion. It's psychological. We want someone to connect the dots and tell us what matters. And social media tends to reward confidence and speed, not necessarily nuance. A 16-second video is not going to relay a lot of information that we actually need. And so the thing that we are seeing is that the loudest and the most confident and certain voices travel the furthest, even when the underlying point is incomplete. So for me, I think the filter really matters. And the first thing I look for is whether the argument is actually causal or it's just a pattern. So a lot of content points to historical charts that always precede a crash, but very few actually explain why that pattern should hold today. And that's where the work is determining if a pattern that exists before makes sense that it exists today. And so the reasoning does not link back to earnings, liquidity, policy evaluations. Most of the time, it's usually noise. The second thing I would ask is what would actually prove the idea wrong? So good analysis always has a breaking point. And if someone cannot explain what would invalidate their view, I think it's probably more narrative than thinking. And then the third thing I'll try to do is try and separate tone from substance. It's not necessarily easy. So if something is designed to make me feel urgent, fearful, or like I need to act immediately, I need to get this product now, I need to sell these XYZ stock now, I tend to slow down because most long-term investing decisions don't need to be made in a rush. So I think, to cut a long story short, for retail investors, it's less about ignoring these voices and more about putting them in context. Fine, it's good to just kind of know what people are talking about, but it's also wise to just put them in context and realize what's the aim of the message. Markets will always have risks, but reacting to every viral warning usually leads to worse outcomes than sticking to a clear and tried process. So yeah, that's my advice.
So yeah, Richard, this question about conflict in Iran leading to inflation and a worldwide recession, it kind of comes in a little bit, or it ties in nicely with what Theodora was just talking about on finfluencers and crashes. So the reality is there has been a pickup of inflation. We're seeing that come up in data across the world. But some countries are more immediately impacted than others. But the really important thing is global growth is still expected to be around 2.9% this year and 3% next. So inflation has picked up. Maybe it's expected 3.7% this and 3% sort of in 27, but it's not enough to undermine the growth potential. And the reality is that AI spending is carrying stock markets economies around the world. You think US, Taiwan, Korea, and even Japan, they're all reaching new highs right now. And the impact on different economies varies. The US seems to be relatively more insulated than others. in the Middle East, obviously, they've been impacted loads. In Europe and UK, they're getting hit sort of pretty hard, but it's not undermining enough to send to negative growth. I think the Euro region's expected to be about 1% growth this year, and maybe a touch more than that next. So to come back to your question about crash fears, if global growth starts to move to negative territory and those signs of a global recession, or the market starts to expect a global recession with negative growth, then obviously the risk of a stock market crash increases. But it's far from a base case from what people are expecting right now. And that's why talk of a crash seems to be, well, it's just talk for now. And there's absolutely no signs of it, at least for now, in the stock market.
Yeah, it's a good question. I'll try to give a very objective answer, as opposed to, give outright financial advice, investment advice. But long story short, so out of the two ETFs that you mentioned, I personally would go for the State Street one. It's slightly cheaper, it's smaller in size, but still very liquid. But the key thing is, I think the exposure to small cap stocks is quite good. So with this particular ETF, the one that you mentioned, the State Street one, so it's really the broadest set of exposure you can get to stocks. So it's All Country World Index, MSCI All Country World Index. So you're getting exposure to both developed market and emerging market countries. And then it's all across the market cap spectrum. So large, mid, and small caps. And the reason why I personally like exposure to small cap stocks is, if you look historically, if you look at the empirical research, there is a risk premium associated with investing in small cap stocks. So what I mean by that is there is a return to be made, excess return to be made by investing in small cap stocks. And it's not completely illogical. If you think about it, these are smaller companies. When you're starting off from a much smaller base, you have much higher growth potential, right? To go from a $500 million market cap stock with a small amount of revenue to, a $500 billion market cap stock is easier to do than if you're starting off at like 5 trillion, almost 5 trillion, like in Nvidia's case, and you're trying to 10x that. So when you're starting off with a smaller base, there's higher growth potential. The second key thing is, these smaller stocks tend to be more overlooked by the investment community, both professional and non-professional. And when many of these stocks are overlooked, that leads to mispricing opportunities. So there's more what we call alpha essentially to be made. So there's more potential mispricings that can be spotted in small cap stocks and more money to be made. That's another reason why collectively as a group, small cap stocks tend to perform well, or give you a risk premium and excess return above the market in the long run, okay? So that's why I like that. Now, as to your second question on whether you should add this particular JP Morgan US Select Equity Fund, personally, the way I view it is if you add this, you're doubling up on your US exposure. Now, the first ETF that we're talking about, the State Street Spider MSCI All Country World ETF, like I said, it's global and everything, but because the US stock market is so huge relative to the rest of the world, by investing in that ETF, 60% of it is in the US already. So more than half of your exposure is in the US. So if you add to this a mutual fund that's purely invested in US stocks, then you are literally just doubling up your US stock exposure, and you're going to go from 60% to, well, depending on how you balance it, to 80%, 90%, who knows. And I don't think that's necessarily a wise thing to have such high geographical concentration in a single country. Personally, I think if you wanted to diversify, it's not to do it by adding more stocks. So if your main ETF is this State Street Spider one that invests in global stocks, and you wanted to add something for diversification, I personally don't think the answer is to add another stocks fund or ETF, because in that particular ETF we're talking about, you already get very broad exposure to global stocks. I think if you wanted to better diversify, it's worth thinking about other asset classes to add. So I'm talking about bonds. You've got government bonds, corporate bonds, and inflation-linked bonds, and emerging market bonds. I'm talking about commodities. I'm talking about gold. Gold being a subset of commodities, but kind of does its own thing. And then some particular ETFs in case you wanted to explore these particular asset classes. And I made sure these are UCITS, London listed, so accessible for European investors. Just ones that cover each asset class. Please, full disclosure, do your own research, see if these ETFs are suitable for you. But I'm just highlighting very big liquid ones to get access to different asset classes. So you have the IGLA, which basically gives the exposure to global government bonds. You have IGIL, which gives the exposure to global inflation-linked bonds. Then you have JPEA, which gives the exposure to emerging market bonds. And then you have ROLL, so ROLL, which gives you exposure to a broad basket of commodities. I would have a look at these funds and I would consider diversifying the portfolio across different asset classes as opposed to doubling up on US equity exposure.
So yeah, another quick update on Indra Sistemas. Like, the stock's done really well. The stock is trading around 52 euros. That's roughly double what it was a year ago, but still some way short of the peak of 66 euros that we saw just a couple of months ago. So definitely the shares have had a huge run, but they've also pulled back from highs as the market just works through some of how much of this European defense story is now priced in. So let me, as an update, just first talk about the latest results. One thing that's quite interesting is that the latest results were mixed on the surface, but it was actually much stronger underneath. So first quarter revenue grew about 15%. That was roughly 16% below where Wall Street analysts had modeled it. So the headline on the surface looked like a miss, and the stock dipped initially. But the market's wise, right? And it looks beyond the surface. Everything below the top line was actually much better. EBITDA was up 55%, EBIT was up 24%, and order intake grew 56%. And their backlog hit 20 billion euros. It's up 150% year on year. Those are huge numbers. So what the underlying is actually telling us is that demand for Indra Sistemas is clearly not the issue. The issue for them is more about how quickly those big contracts convert into revenue. And then what was interesting on the call as well is that management also gave a useful bit of color and execution. So they said they already delivered 3 Redas under a December contract by the end of April. So that was just like a month ago, which is, to me, I think, a pretty clear signal that the business can move quickly. They also reaffirmed, importantly, double-digit revenue growth for the rest of this year. So the one thing I'm watching now for them is cash flow, because the CapEx ran heavy this quarter. Unsurprising, because they just have lots of spend and demand that they need to work through. Bigger picture, just zooming out, talking about the bigger European rearmament theme, I think that still looks intact. So Spain's special modernization programs are starting to flow through, and Indra looks like one of the clearest beneficiaries. No change there. Their defense revenue grew 32% in the first quarter. Their defense backlog rose almost 3 times, 300%. That's massive. One other major development I definitely have to talk about is governance. So that was the reason why the shares sold off so much in the last couple of months. But we've seen a real clear stabilization story there. They had a conflict of interest that emerged around the proposed EM&E merger. That issue has now been resolved. They've got a new non-executive chairman that was appointed in April. And so what I would say is that overhang is now gone. The EM&E deal is paused rather than dead. And actually any restart now should actually come on much cleaner terms. So all in all, I'm still positive. The backlog has more than doubled. Margins are expanding, which is great. The space angle with their Hypersat deal is also becoming more meaningful, and governance now looks more stable. So I'm staying long with medium high conviction. And if there are any pullbacks, I would definitely buy into it rather than chase the strength now.
So, David, thanks very much for the question. There's a library out there on Finimize, as I'm sure you're aware. One insight written by Theodora that kind of answers good parts of this question is how to know when it's time to sell your stocks. And relating it directly back to the problems of loss mitigation strategies and changes in the original investment thesis, Theodora highlights a few of the issues that can come about. One could be when the company's got, a profit warning or something like that. And there's definitely some portfolio managers that first signs as a profit warning, they'll sell straight away. So that's kind of a pretty aggressive approach, but, may not be suitable. It doesn't mean that necessarily the investment thesis has changed. It really is important to judge each idea on its merit. What's the issue? Is it serious? Is it a temporary cyclical factor, or is it something more structural? And so I think one thing there could be, the software stocks that we're seeing in AI right now. Has AI really upended the whole structural argument for software? Or is it valuations? Are they going to have a business? Is Figma or Adobe going to have a business with, all these, new AI sort of like LLMs coming through? So that's kind of where it becomes more structural rather than, there was a bit of a slowdown because, orders dropped away because of a slight slowdown in the economy, like the macro picture. And then another reason to think about is if the investment thesis changed. One reason why you bought the stock originally is because you thought it was cheap. And so then maybe it's gone up in value and it's no longer cheap and it's kind of reached fair value. And it could be that there's better opportunities for your money elsewhere. So you're going to switch out of that into sort of another idea that has better upside or more upside than that. So that's obviously important. And that's going to be your key driver, your fundamental reasons. What's changed in the thesis? Is it permanent, structural, or could it just be for a quarter or two and actually still like it? And then tying in with that a little bit, but definitely a secondary factor would be where maybe you want to use technical analysis to come in. And you can use longer dated moving averages like the 100-day or the 200-day to see, if I still like it fundamentally, but hey, look, the technical picture's telling me something else. So when a stock or an ETF or whatever asset you're owning falls below the 200-day moving average, that could be like, hey, look, I think X, but the market's thinking Y, and it could be time to get out. So personally, I like to use both. Obviously, the fundamental side and using that how to know when it's time to sell your stocks. And then second one, well, actually, how much has the market priced in? Does it look bad, but the market still likes the idea, or is it looks bad and you know what, the market's saying get out because it's dropping below sort of what I'd argue long-term technical support levels?
Yeah, I mean, look, this is a very good question, and just a couple of points I would say on this. So first of all, reading news and analysis isn't always about spotting a new investment opportunity. That's not always the end goal of reading news and analysis. At least it's not for me. Think of it as ways to become a better investor. So think of them as a form of education, essentially. Over time, you build a clearer understanding of how markets work, how certain things happen, and how markets react. The more you read the news, then you just kind of become second nature. Like, oh, okay, you've got an oil shock, higher inflation expectations, bad for bonds, etc., and so on. It just kind of becomes second nature. Then you are exposed to different analysts' perspectives and interpretation of events, and so on and so on. Now, balance matters. Spending hours consuming news can quickly lead to information overload and is highly discouraged, honestly. I think focus on what genuinely interests you, and on high quality, thoughtful analysis of major market and economic trends. Just as importantly, do not feel compelled to act on every new piece of information. If you are following a rules-based strategy, stick to it. The key thing about following a rules-based strategy, honestly, is to just stick to it if it's a sensible strategy and the rules are very sensible. A useful way to think of all of this is your portfolio rules should drive your actions, while news and research mostly serve as context, but not a reason to constantly change course. So that would be my recommendation to you.
Okay, yeah. So another update on Rolls Royce. About 6 weeks ago, I moved Rolls Royce from a buy to a hold. As I stated in my thesis, I wasn't worried about the long-term story. All three divisions, civil aerospace, defense, and power systems, they all have multi-year tailwinds, which make the story really exciting. I think the issue I had was just the near-term uncertainty around engine flying hours, especially after the Iran conflict broke out. The other thing as well is, the stock has had a 10 times rally, so I was very conscious that the valuation simply didn't leave any room for disappointment. So update 6 weeks on, the stock's down about 10%. It's not a disaster, but as you can see, when the market's had a run and Rolls Royce is down 10, that's not great. So I think I'm glad I put it on a hold. I'm not stepping back in just yet, and I'll detail the reasons. So the April 30th trading update actually went pretty well. The headline was the most reassuring part. So engine flying hours, which is the variable that I previously flagged as a hinge of the whole thesis, I put it to a hold, came in at 115% of 2019 levels. That's the bottom of management's previous guidance range. But more importantly, it's not a miss. It's at the bottom end, but it's not a miss. Even better was that Trent XWB activity in Middle Eastern airlines had actually fully recovered to pre-conflict levels. And so the geopolitical shock that triggered my downgrade hasn't actually broken the model yet. And then we talk about defense. Defense had an excellent quarter. New equipment deliveries grew over 20%, and the company landed 3 more meaningful contracts. They also reaffirmed full-year guidance, both in terms of operating profit and free cash flow. No change to that. What was a little bit iffy was that, as I've mentioned, the flying hours numbers which they talked about was at the low end of the range, not the high end. So management could have surprised positively, but didn't. The guidance was reaffirmed, not raised. Now this is interesting. This is normally a good sign, but for Rolls Royce, after a year where they have been beating and lifting consistently, they have had such high valuations, that's a subtle change of tone that we're seeing from them. And add on to that, the macro headwinds haven't cleared. Jet fuel is up, more than 100% from the end of 2025. Lufthansa is cutting tons of short-haul flights. Spirit Airlines in the US, they have wound down. So lots of airlines are kind of in trouble. Arguably, yes, most of those cuts are from short-haul, narrow-body aircrafts, which Rolls-Royce don't power. But definitely, I think the conflict drags longer, as we are seeing. Then I think wide-body operators, which is more important to Rolls-Royce, may turn more cautious also. And the reason why I'm still on the sidelines is, to summarize, is that the risks have caught out in March, haven't exactly fully cleared. The operating leverage that we've seen historically drive Rolls-Royce margins can work in reverse just as quickly. So that's my concern is. The valuation still doesn't leave much room for error. And the first half results for them, it won't be out until late July or early August. So we do still have a couple of months of summer aviation noise to navigate before the next clean data point. So what I think is the stock could definitely drift sideways or lower through summer. What would get me more positive is potentially if it, dips another 10% lower, nice entry point, I would get in. Especially with the first half results confirming that their 2028 plan is intact and engine flying hours are fine. I guess, that's a setup I'll be waiting for.
Awesome. Thank you so much, Russell, Theodora. Thank you, everyone, for tuning in. Really hope that was useful. And, we'll catch you at the next one. In the meantime, like I said, if you have any questions that you want answered at the next one, feel free to shoot them via email. For now, thanks again for tuning in, and see you next time.
Thanks guys. See you soon.
Thanks very much for listening in, and keep your questions coming.